Welcome to the DevReady Podcast, where we're helping non-techs build great tech. Today, we're joined by Matt Allen, who was once a tech in his day, developing in the early stages of his career, and all the way through to recruitment, Amazon, and startup ventures, a bit of angels all together in between, and supporting a number of angel ventures. I think plus 60 you mentioned, Matt there. And then now in Tractor Ventures, which we also had Jody on the podcast, probably last year now, talking about Tractor a bit. We'll talk about that as well and just share a bit about the opportunities for startups and startup founders and businesses that are looking to get some debt financing into their business because there are different ways, not just VC. Matt, thanks for joining us.
Pleasure. Thanks for having me.
Now, let's go through your background because it's quite interesting in terms of the angles that you've taken in terms of getting into where you are today, and it's probably led on each other. You mentioned development in the early stages, probably not too important to what you're doing today, but what are you seeing in the world of development these days? Are you still got any hands on the tools, or are you just more in the finance caper these days?
Well, it's funny. What I didn't tell you is that, yeah, as of the last couple of months, I'm absolutely back on the tools and taken over the CTO role at Tractor. So,
Have you now?
having started
Okay.
off as CEO, then
Yeah,
Jodes and I did co-CEO,
yeah,
and I was head of capital and she's CEO. I'm
yes,
back on the tools, and the reason I'm back on the
yeah.
tools is because the modern platforms and AI allows
Mhm.
me to do the things that I stopped doing 10 years ago and clocked off because I was good at parts of it and bad at other parts of it.
Mm.
Allows me to actually like be extremely productive back into what I'm doing now. So we have a whole back-end platform at Tractor, including our credit engine and our platform that our team uses to do all the work and the customers use to apply.
Mm.
And I'm building a whole bunch of componentry in there that I've had in my head for a long time, and it's very efficient to get it out nowadays.
It's quite rewarding if you've got some development background, what you can possibly do. It's
Yeah.
the what we see is a lot of the real non-techs are trying to vibe code some stuff they really can't get to an outcome. Well, they can get to some prototype outcomes, but nothing that's really going to be robust at this stage because they don't know how to get there or close the gap on that. But yeah, the landscape of technology is changing significantly and what's possible.
Yeah, and I've got some a really good real use case. My partner is building some stuff for
Yeah,
her company as well, using some of the platforms, and it's amazing to get going. But when things go wrong, they go really wrong, and it's
it
very
can.
hard to
Yeah,
unpick itself.
yeah.
And the thing that I've realized is that devs, good devs are still going to have jobs for a long time because you know the challenge about if you're coding and not understanding what's actually being built is that it will, the higher order commands you give it, the more abstract it'll do and the more likely it'll tie itself in knots. And when
Correct.
things go
Yeah.
wrong, yeah, they really go wrong. Things
Mm.
like I had to run an extremely strange Postgres permissions plan thing to unpick itself that it got itself into the other day, and everything started working again. But I found that on a weird Reddit thread. Like, there's no way on earth you could debug that if you didn't know.
Yeah, you have to actually know where to look and think about it or what to even consider. That's the problem. Yeah.
Precisely. So I'm very grateful for my 10 plus years and 15 years of actually writing production codes so I can understand what it's doing, and even now guiding it through writing tests, failing tests first and TDD, and then coming in behind it and making sure that it actually is robust, and when it starts going a bit rogue, we have the testing framework to make sure it hasn't blown everything up.
What tools are you using if you're developing? Are you using Cursor or something along those lines?
Claude, just Claude inside Visual Studio, and I'm writing a modern a Rails app Tailwind and Postgres. Like, it's a fairly vanilla stack, but it's good at that stuff. Like, it's good at those patterns. Those patterns are well established, and I have to keep it on track because every now and then, like the other day, it started writing Python. I'm like, what are you
What are you
doing? This
doing?
is a Ruby on Rails
Exactly.
app.
Yeah, but if you don't know, then you just let it write Python, don't you?
Yeah,
Yeah. So that's the reality, and then it all goes off the
yeah,
kilter, which is what it can
yeah,
do. So having
yeah.
some dev support behind vibe coding is just like a rocket fuel to your application now. It
Yeah.
comes at that. No, really good to hear what you're up to. Let's go back in history a little bit. So you were in the world of recruitment in the space of technology. You mentioned recruiting for the likes of uh, you've mentioned realestate.coms, etc., in terms of tech space.
Mm.
How did that sort of venture into building out a network in the space and growing out where you are today?
So I started in Sydney. I grew up in Sydney, and was a sort of a self-taught software engineer, and ran a few startups, as the CTO or as the software developer throughout the early 2000s. And at some point in time, I realized that, coding and the grindy in the middle bit was like not as much fun as you think it is. I had a lot of mates who would call themselves software engineers and craftsmen and would build beautiful software, but I'm more of a commercial, like I want to get it done and sort of get it in the hands of customers so we can go fast.
We sound very familiar. I was one of those coders at the beginning. So a long time ago. I haven't touched code for 10 plus years, but I've been doing a bit of vibe coding on the side. But it's probably stay out of that wheelhouse these days. But my team run that. Yeah, I feel what you meant in terms of just getting stuff out. This would be perfect.
And I'm self-taught, so I'm not I
Yeah.
never did uni. And the irony is finished high school. Well, the interesting thing is I finished high school in 95. The first web browser came out in 93. So
Yeah.
I've been doing this stuff since the web literally formed. So it feels to me like learning back then was about, there wasn't a bunch of literature and books and stuff. It was just absolute cutting edge, trying to
Just
figure out,
jump
trying
in
to
and see
keep
what
on and
happens.
stay right up
Yeah.
when as
Yeah.
browsers were evolving and the code was evolving behind it and being able to do that and then getting to server-side code, running my own hosting company so I could run my own server-side code was just the way things were done back then. There was far less abstractions or far less frameworks. It was pretty raw. And that's just how I grew up when it comes to technology. Yeah, as you mentioned, I got to the point where I'm like, I'm not sure I want to write forms and buttons for the rest of my life. Is that how it felt like? Felt very repetitious. And
Yeah.
now with AI, repetition is not a problem because it can do the
It can
repetition
do it,
stuff and
yeah,
I
do
don't
it
have
for
to.
you. Correct.
Which is kind of, I guess, what I'd always hoped for is like, why am I writing yet another web form when the patterns are well established and it should just do it, give me the shits. Um, so I approached my friend Steve, who ran a recruiting company. I said, "Hey, you run a recruiting company. I've been part of this community for a long time. I don't think I want to write code anymore. Is there something you think you do?" And he's like, "Yeah, like we only hired devs. We didn't hire salespeople. And recruiting is always that sort of icky sales process. But if you've got someone who actually can have a conversation about the actual problem you're trying to solve, the code you're writing. And on the buy side, the CTOs and the hiring manager that I was working for, you know, appreciated somebody that could actually probably actually apply for this job themselves and get it done, having had senior positions.
Yeah, and actually understand what's going on. Yeah, not just having a top level, surface level. What is that? What is that? Ruby? Or .NET?
Yeah, so what is that, Java or JavaScript? That's right, two very different things.
Yes.
So that was good. Sort of did 4 or 5 years that, moved to Melbourne in
Yep.
2013, 2014. Did that, had a team down here. Turns out that I'm not particularly good at the middle of many processes, including sales processes, of which recruiting is. So I got to the point where I was like, I can't just do this same thing over and over again because being a good recruiter is doing the same thing over and over again and getting incrementally better at it, every single time, and being very comfortable sitting in the, in between a hiring manager, a candidate, and a job, and trying to sort of do that three-way
Yeah,
sales
massage
process
that.
is
Yeah.
quite challenging. So I was pretty good at it. It was quite lucrative. It allowed me to start investing, which is great. But then I got tapped on the shoulder by a mate of mine, Ian Gardner, who works at Amazon AWS. And he was on a very small team back then called the Startup and Venture Capital team. It was just him and one other guy, Dan. And they were basically running all of Australia and New Zealand and he said, if I don't hire somebody in Melbourne and stop coming down here every week, like my wife's going to kill me. So I was the third person on that team in Australia, probably the 60th person on the team globally. It was a global team,
Okay.
and I was spread around the world. And our entire remit, it was a BD role, so it wasn't a sales role, wasn't selling anything. BD roles just go out and help every founder with their cloud thing. So it was me, a mate of mine, Glenn, who was my solution architect. So I was sort of BD guy, he was tech guy, and we'd go out and talk to accelerators, VCs, scale ups, and try and understand what they're using, and then hopefully make them use cloud more, use more AWS. And I also had 100 grand in credits to give away, which was always handy. So
Bonus. I'm sure that brought a lot of people over.
it
Yes.
wasn't it wasn't particularly hard to get a
Yeah.
conversation. Although most
Yeah.
people were kind of
Yeah.
confused when I first called them and hey, it's Matt from. They're like, who, from where, and where are you? I'm like, I'm in Melbourne. And they're like, no, you're not. Like, I mean, there's no one here. Because
Yeah.
it turns out there was thousands of people here, but nobody kind of knew. So it was pretty early on in the days, 2017. So that was 2.5 years. It turns out that was the first job I'd had in a very, very long time. Um, it worked for about 2.5 years, and then it stopped working because it turns out that being part of a very large global organization, I think we crossed over 1 million employees while I was there.
Oh,
I'm
wow.
like, this is not really the kind of environment that the guy who likes to build stuff from the beginning can thrive in. So it was just a mountain of email, and it was hard work. So I managed to at that same point in time, I had a minor, not a minor, a secondary opportunity to sell some of the shares I'd in one of my angel investments, and allowed me to sort of resign from Amazon and ponder about what's next. And that's when we started Tractor. It also when COVID came along, so
Mhm.
turns out that tweeting at people from the couch is not a job, so I need to do something. And this is why we started Tractor, or at least the environment with which we started Tractor.
Let's talk about, before we jump into the tractor, angel. What got you interested in angel investing? Was it you just jumped into one idea and then it started that? Did you join an angel syndicate? What was it about angel investing that got you involved?
So it was we had in my first startup I had one angel investor, and he's a good bloke, sort of brought his money and brought his advice. And turns out being a founder is really hard, and being an investor is far easier than actually having to sit there and grind everything out all day long.
Yeah, it's
So
a
I just
fair point.
decided I wanted to be an investor.
Okay.
And rightly or wrongly so, I'd made a pretty big bet on Xero, the accounting platform, and sort
Okay.
of
Yeah.
put our entire self-managed super fund on it on day one on the
Oh,
ASX,
wow.
and it popped pretty
Yeah.
significantly. So I had a bunch of capital that I
Yeah.
didn't have prior because I don't come from money. It was just just happened
Yes.
to be that was the thing. And then once I decided I wanted to be an investor, I just started tweeting at people like Nikki from Blackbird and Mike Hannah Brooks on Twitter. And Twitter was pretty
Mhm.
interesting back in the day, and it was far less antagonistic and far more open. So I just asked, had some ideas, asked some questions, got some feedback. And because I was a dev, because I was a software developer who was now deploying some capital, had a lot of technical founders come to me first because they're like, "Hey, I can talk to you about the problem because I don't have to explain to you the problem because you're already a nerd.
You
Like you'll
get
get
the
it."
idea, yeah, and from a technology standpoint, not just from a business lens and how do we make dollars
Yeah.
out of this. Yeah, you can really
So
see
there's a
it.
few of my
Yeah.
early investments were with dev tools. So with tools
Okay.
that software developers made for other software developers. And
Mm.
being a software developer, I'm like, yeah, cool, I understand the problem. Like we don't have to talk about the problem. Let's just talk about how we're gonna win here.
Mm.
Um, which I guess gave me a little bit of a boost and had a couple of good early investments. And it turns out that one day Nicky from Blackbird came down and we sat down and had a coffee, and he was looking for some scouts before they had anyone in Melbourne. Was like, we want a few people to sort of do some investing with us, and he asked me to do that, which was really nice. We did a couple of investments that have since exited. They weren't rocket ships. They returned money, multiples, but not rocket ship
Oh.
multiples. But that was nice. There was only five.
Any return's a good return. The reality is, if you go into the share market over 10 years, you double your money. 7, 10 years,
For
or
those
property.
for
So,
those big funds, they want big returns. But yeah, but
mm.
anyway, there was five of us, and I was the only one that wasn't one of the CEOs that invested money into. So I was like, so I'd done something to the point of being able to be,
Yeah.
publicly visible enough and asked enough questions, and hopefully had enough, of a reputation to be able to do that. So that was fun.
Mm.
And that sort of also helped me get the job in Amazon because, they needed somebody who already knew the
Had a
ecosystem.
bit of a
So
network and ecosystem. Yeah, it does help,
yeah,
of course.
yeah. So that was kind of how that worked. And I guess it was just a you know, getting a little bit more disciplined about writing more smaller checks rather than fewer bigger
Hmm.
checks, which you get excited at the beginning and then you sort of run out of money. So it was always I'd had the opportunity to take some early secondaries off the table, which is when it's not the exit, but along the way
Hmm.
the shares you bought prior become, someone else wants to buy them, and the company doesn't want to sell anymore. So you get this opportunity to sort of sell them.
Sell some
And
out.
I did do that, and it sort of kept the revenue coming back in, or kept the capital flowing back in, which allowed me to keep going
Mm.
because, as it was it wasn't an unlimited pool of capital. There was a very finite amount.
But it's still, you're holding these investments and they are there for years. They're not there for minutes, right? So, and their capital sitting there for 5, 10 years in some cases. I'm sure you probably still got a couple running. I'm certain you would if you got,
Most of them,
you've
like
got,
they're either
yeah, yeah,
they're either dead or still going. Like there's very
yeah,
few that have actually got
yeah.
to the end where there aren't
Mm.
any left, any
Okay.
shares left. Yeah.
Yes. Yeah. And that's the thing in Angel. Are you still angel investing today, or you've sort of stepped away from that?
Very rarely,
Very
very
rarely.
rarely.
Yeah.
I
Yeah.
just focus on tractor and sort of
Yeah.
I do a
Yeah.
lot of scale up stuff now. So I'm
Okay.
more likely, or less likely to deploy capital into that at the
Yeah.
moment. Yeah.
Yeah. Makes sense. What's angel investing taught you about startups, founders, and everything in between? What have you learned from being a part of angel investing?
I look for me, it's like it is people. Like it's actually like it's especially when you're writing those super early checks. So a couple of things is that you can't. It's an irrational investment, which means that as soon as you sort of get comfortable with the founder and the dynamic between the founders, the problem they're solving, their experience in whatever they're going to do, just write the check and get out of the way, or try and be helpful, but certainly don't be slow, don't be annoying, don't do that kind of thing. And what I've learned about investors is that there's very few who actually have conviction to lead anything. Like, most founders will speak to heaps of people who will happily take the terms someone else writes, but to actually write some terms and say, I'm going to give you this money on this valuation or whatever the case may be. And especially back in the day, there was just very few people. So it got to the point where, annoyingly for me, is that like I'd say yes. I
Mm.
don't really like at early stage. I'm not negotiating, plus minus a little bit on the valuation, whatever. It's like I've got 20 grand for you. Here you go. Like chuck it in the pile. But that'd then unlock the rest of their backlog of people that said, "Oh, well, Matt said to give me 20 grand at this valuation," and everyone like, "Okay, that's fine. Off we do that."
Yeah, and
But
then everyone sort of jumps in because no one really can be. Yeah, that's interesting. So there's a bit of follow on from that, of course.
you effectively stake your reputation on it a little bit, right? A little bit. And there's a few of them that blew up, and I'm like, well, that wasn't great. And a lot of people came in behind me, but it's like that's the risk you take. You either
That's the reality of the game, isn't it? Yeah, it's high
yeah,
risk or a high return game. That's what it is.
yeah,
Yeah.
do your own diligence. If you're going to lever mine, just know that there isn't much of it at that early stage. Just,
Mm.
like be clear that I've probably had a few conversations and it seems interesting and they seem like they know what they're doing. I might be able to help, but it's not like I've gone into the code base or anything really. So it's a challenge when, yeah, a lot of people are, as an investor getting to conviction. He's like, founder getting conviction to start going. Lots of people talk about it, but very few people do it.
It's true, just getting started. Yeah, and I'm seeing a lot more in the space of people talk, being able to do a little bit more. This back to the vibe coding thing. People are trying to do more and start more, and that's a good thing. I think it's a great thing. I just it just how many will actually get off the ground is going to be still very little that will get some return in my mind.
Yeah.
Yeah, so that's the real reality because it's not about the technology at all in the end. No, that's what we're seeing, and it never has been. It's unless you're down in solving dev problems or something really low level. It's never
Mm.
about the technology. It's about how you execute, how you roll it out, your channel partners, your market, your marketing angles. What does it look like? How do you position yourself? Well, that's where the rubber really hits the road. And are you adding value? Are you learning with your customers? It's just never around that initial idea anyway.
Yeah. I mean, it effectively comes down to distribution, which is like if we assume that the product will you understand the problem to solve, the product will solve enough of it to create enough value so you can charge for it. Um, can you sell it? Can you sell it? And can you sell it beyond, your mates? And that's for most people that's hard because most people who have got the first two under control, like we understand the problem, we've built something that solves the problem in a way that the person using it will pay for it. It's like most people don't identify as salespeople, and sales is a weird thing, especially in Australia and New Zealand. There's a little bit, you don't want to sort of go out and sort of bang your own drum, but founder-led sales, most people should be founder-led sales until they hit, millions, plural, if not five or six or 10, really just keep doing it, right? Because ultimately, like, you're not a salesperson, but you understand the problem, and all you do is talk to the problem until they say, okay, explain to me how your stuff works. And if you
Mm-hmm.
understand the problem, then hopefully the solution is good enough and hopefully they buy it. And, people who are just salespeople are probably not incentivized the same way as a founder. So founder-led sales, most of the founders I know are back on the front line. They're either coding or they're selling. Like that's
Yep,
kind of where the
one or the
founders
other.
live. Yeah.
Yeah, no, that makes sense. Look, thanks for sharing a little bit about that space because it's always interesting and fascinating in terms of the angel side and how you might drive it. And it's something for people to think about if you are a founder in I agree on the founder-led sales. You understand the problem better than anyone else. If you're technical, it becomes a challenge in terms of how you might do that. Maybe bring on a founder that's a bit more front-facing. Could be an angle to consider because it doesn't have to just be you, especially if you're a technical founder specifically. But if you're non-technical, must be driving the front of it. And founder-led sales is more than that too. It's a whole learning environment that you can be in and understand the customer from a market research perspective at the same time. So there's an
Yeah.
advantage. If you don't get the sale, you're going to get some feedback and research you can take back into product or into direction of how you might communicate the product in the first place. So there's a lot of
Yeah.
opportunity there.
The tension between like I think customers love to know they've got a decision maker on the end of the call, right? So, a founder knows the state of their organization, their platform, what they can do and can do it. And they can say, yep, yes, yes, I can give you what you need, and then turn around to the team and say, hey, listen, we need to adjust things, we need to prioritize this, we do whatever. Where, people who don't have that level of connectivity or that level of authority, or even the agency, is it like, you're going to run into these barriers as you do when you're talking to a customer. They're always going to want more, they're going to want pay less or whatever. And like you can make those decisions on the trot and get the job done. Where I think, someone who doesn't have that level of agency or understanding internally is always going to struggle. Um, and that's, I've seen it a million times. And ultimately, that's your secret weapon. Um, you just need to balance the tension between saying yes to stuff you may not have yet, or understanding, turning around to the team and reprioritizing the backlog is now something we have to do.
Oh, because you're all over all angles, right? So you do know the ins and outs. And that's a fair point because you're in a conversation. Customer said X. Yeah, we don't have X, but I know that if we do one, two, three, we can get to X pretty quickly.
Mm.
And it's not going to cost us too much to bring a customer on and longevity of the customer. So you can make those decisions on the fly. If you don't have the product nous and the backlog nous and what's going on holistically around the business, then yeah, you will struggle with that, making those decisions. It's more, no, we can't do that, or I'll have to get back to you, and it slows down the sale or probably just dissipates it out the door. Yeah.
Yep.
In terms of, let's jump onto Tractor a bit now. So, angel investing, went down this path and decided to go jump into your own startup again. Why? Why? Right? Yeah.
Oh, it's a good question. I'm a bit of a goose because I'd already definitely identified as an investor there for a decade, and then I'll go and do it again, and I probably won't do it again after this. Look, the same reason what we just spoke to, like the problem that I saw when I was in Amazon, and I used to speak to all the tech founders, not just the venture-backed ones, and we used to get these spreadsheets full of like people's billing data on a little Spark chart, and it was sort of, you see this billing go up to the right, and cloud consumption and growth were kind of a proxy for each other a lot of the time. You never heard of these people. They're not Canva, they're not Atlassian, they're not someone sitting in Nikki's Blackbird Pro. They're just you never heard of them. And you go and have a look, and you have a talk to them, and they're running this business. They're doing millions of dollars in revenue. A couple of blokes, in a couple of people in a an office somewhere, who are not venture backed, who are just running off customer revenue, and the conversation is
And
always
they're
like,
a
well,
real business. That's what they are, actually.
yeah, and
Yeah.
and and so my hypothesis when I started Tractor was that in a standard distribution of any of tech businesses, you're going to have the outliers on one end, which are your absolute VC rockets. You're going to have a whole bunch of people doing effectively small single person businesses that are not really necessarily something that other people want to go. But in the middle, there's this group of people who are just regular people. They're not their ambitions are high, but they're not willing to sacrifice this thing that they've built that's working quite well on the hope that it might turn into some huge thing. So the the understanding, though, the insight that I had was those people would like to oftentimes want to invest ahead of their revenue curve. So if they're bootstrapped or they're very closely held, they might have only taken a very small amount of money from other people or none. So their revenue governs their ability to invest, to pay for their people.
It does,
Um,
yeah. And the revenue, it's also just, it's your profit really to invest. It's not even revenue. You have to be profitable
yeah,
for,
you're making a decision every day.
yeah,
Yeah,
yeah, yeah.
there's a point where it crosses over, right? For a
Mm,
while, you're spending your
mm,
time often
mm.
until
Yes.
the revenue exceeds your fixed costs, which is
Mm,
might only be a couple of founders, might be a small team,
mm,
but at
mm,
some point in time, it crosses over and then you're reinvesting. And that backlog we spoke about is like, we think we can turn some of this backlog into more revenue, but I'm choosing what to prioritize on because I've only got a finite amount of incremental revenue every month coming in. So the conversation that I had, and I think that founders haven't been able to have, which is, how do you get ahead of your revenue curve without either A, promising to turn, a nice three times, yearly growth company into a 10 or 15x, and taking capital on and hopefully doing that, knowing that if you don't do that, it's probably going to go to zero.
It's going to die. Yeah, correct.
Or
Mm,
turning around to the bank and saying, "Can I borrow some money?" And they're like, "Cool, that's a nice house you have there. I need you
mm,
to tell your partner that you're gonna put your house at risk as well as all the time and everything you put at risk." And most people are just like, "I don't think I don't think I want to couple those two things tightly."
mhm.
So there was an opportunity to go, what if these businesses that have high gross margins, that have recurring revenue most of the time, that have either contracted or recurring revenue and good gross margins, are able to be lent against? My hypothesis was, if we took in the higher order data, like their accounting data, and understood how they ran their business, and we could actually lend to them, without having to take the house, because we're underwriting the business, and its historical patterns. So we did that. So we started Tractor. So the VCs do the rockets. The rockets are all very exciting. They're very hard to land. They're expensive to build, and they blow up quite often. So that's a rocket. And the tractors are just consistent and reliable. And it turns out that there's heaps of consistent, reliable, tech companies. And the reason why they're harder to lend to than an offline business, there's a lot of business lenders, small SME lenders, that can lend to a hairdresser or a hospo or whatever. All those businesses have they have constraints. They have input constraints and output constraints, right? So it's like, you can't scale your cafe more than your cafe will scale. You've got fixed costs, you've got unit costs. You kind of, even if you're doing really run it really well, it's got a capped upside, and you kind of know how it works. And when you've got enough businesses like that, you can kind of benchmark them and go, oh, cafes, plus minus one standard deviation. You're a good cafe, you're a bad cafe. Like, we can tell that, and then you can lend into them.
Yeah, it's fair. It can actually, you're easy to lend to. And every SaaS business is different. Different market, different angle, different product, different everything. So, yeah, it's fair.
So
Mm.
you've got this ability to potentially, most of these businesses we lend to sell globally, or at least unconstrained revenue from their fixed costs, right? It's not like you add a new table in your restaurant and you can serve more people and that's how you scale. It's like, if we sell another SaaS thing, its gross profit could be 90%. And arguably, once you're in profit, that'll just hit the bottom line, because your cogs are you got a little bit of cloud and a little bit of consumption. The rest of it is just fixed. So, like, how do you therefore lend to businesses like that when you can't go, you can't really, at a high macro level, you can compare them. You can go, well, how much you spend on marketing, how much you spend on dev, whatever. But in reality, they're unique businesses, and you have to understand the business. And to understand the business, you got to understand their numbers. Understand numbers, you need to speak to the founder, and you need to sort of rip this stuff apart and understand how the interop between all the parts of the business. So that's what we do. That's what our credit engine does. We look for all kinds of stuff that a normal bank, A, wouldn't have access to, and B, just like off the risk appetite. And
Got it.
then we lend to people who have a very good use case for that,
Hmm.
right? So our first product that we had, we only had one product up until the beginning of 2025, which was a growth product. It was effectively a term loan that would pay down over 24 months. And you would use that when you knew you could unlock growth in your business by deploying this capital. It could be a salesperson, could be marketing, it could be something that's kind of forward deployed, that had an almost guaranteed uplift in revenue.
It's something you could measure back, right? If you're spending 3 grand a month on marketing and you're getting a 10K a month return, maybe we turn it to 10 and then we get a 30K return or a 25. So you can justify a return, or you've got one salesperson being able to do X, Y, Z. If we add another, can we double that, or at least another 50%, which covers the cost, right? So it grows and grows. I get it. Yeah, understand. All right. So you've proven a model. You're not just floundering around trying things. You've proven something's working first.
Yeah, so we talk about founders, like the right time to use debt or finance is when you're doing something's working and you want to do it better, or you want to do more of it. and you know that you put a dollar in, and over the span of time, and hopefully it's not a long time, it's a relatively short time, you sort of you go into the red, then you're in the black, and then you're in the profit over time. So if you understand that level of mechanic in your business, then you can go, actually, I can, instead of spending money at bank or spending money on my balance sheet, I can put some money on via a loan. And even if I'm paying interest, because I've got a high gross margin product, I know that I can actually turn on this, and it turns into like a positive growth engine. And we do work with a bunch of venture-backed companies, and even them, they now, including their VCs, are like, it's really expensive to sell a share when it's going to correlate to growth, because our revenue, our valuation is a multiple on revenue, and the multiple goes up the faster it goes. So if I can drive fast growth, even if I'm accruing a little bit of debt that I'm going to have to service, that's a positive outcome for everybody, including on the cap table, including potentially VCs. But if you're not venture backed and you don't sell shares, then first of all, selling shares is something that's a foreign concept and you don't know how to do it, and you don't want to start if you haven't already done it. But if you do have the ability to drive that growth, and if that's what you want, like if you're happy to, you want to go faster, you're happy to do that because you want that revenue to reinvest in some longer term bets, right? So you sort of finance your growth and then use the excess revenue to pull in the things that you know are going to create long-term value, like improve the product and do the things that you kind of need to take that equity risk on, your internal equity risk, and you can finance the growth of the business. And those two things can work well together when you've got that level of understanding of how your business works.
In terms of some success stories around this model, it's not something that's talked about much. And when I had Jody on the podcast, I said that it's not something that's spoken about a lot in the space. It's either go bang for buck, get a VC. That's what everyone talks about. You mentioned it, I think, off camera, the unicorn, become that unicorn. When people say, I want to be the unicorn, yeah, okay. Everyone wants to be the unicorn, but why do you want to be the unicorn? Is that because it's just the in thing? It's the good looking girl in the room. You want to get the good looking girl in the room. It's the unicorn, right? So, what is it that draws people to that? And I think the reality is that's not business in my mind. It's like build a business that's sustainable and got some opportunity. Yes, if you need to bring on capital because you've got a big enough opportunity to deploy it and actually make it work, that's a different thing. Not just I want to be a unicorn with my idea over here, and everyone wants to be that unicorn. So, I think the startup world's a bit disjointed in my mind. It's all about idea to let's just go and get capital and how do we get funding rather than how do we get a customer, how do we get some revenue, how do we get some business in the door. That's probably the disjoint that I see in the space, being around it for more from a service provider. We own a couple of startup SaaS products ourselves, and probably in the tractor world, like just things that are humming along quite nicely, good margins, good businesses that we can rely on, and good customer base. So I like that type of business because I know that there's something sustainable there, and I'm not chasing that dollar. And I've been around startups that have chased VC money and seen them blow up because of it, and chased good money, and then the founders are burnt out. That all they're doing is chasing dollar after dollar, and it's not cut revenue dollars; it's investment dollars. How would you frame that from someone that's walking to the space? How might you think about a business when you start it, and not just go after VC dollars?
I mean, it's interesting, and also a little bit, I sit in a weird conflicted state because I do have two venture companies, Site Station, Black Nova, who do that, right? They back those founders doing that.
There's
Yeah,
pros and cons of everything.
yeah. Look, it's an interesting, it's not necessarily like an and or an or, you know what I mean? Like it's you can actually blend them together. But to your point is, if you're going to raise capital, you effectively are selling, you are selling, you're selling your shares to an investor who every time, this is the thing I talk to founders all the time, is that if somebody wants to give you money for shares, they're going to expect a large multiple on the money they gave you. So if I, as a pre-seed investor, that's super everything. Like I'm going to expect something like, 100 times my money over 10 years. That's like the interest rate on that is eye-watering. The IRR is eye-watering, right? That's what my expectation is, and that's kind of the contract you sign. You at least, whether you're not signing a contract, but that's the agreement you're participating in when you sell shares. Um, those people are not there for a minor return like a lender. They're there for massive upside, and they don't necessarily want a dividend most of the time. They're there for I want to sell that share in the future for many, many times what I paid you for. Um, and like the cost, the revenue, the cheapest money you're going to get is customer money, because you're promising them you're going to deliver them something that they're going to use over and over again and create and see enough value in that exchange to continue to pay you. And the only promise you've made is that your site or your app is functional, it works well, it's stable, and it's solving one of their problems, right? And back to that founder at the beginning. So that's it. The next sort of revenue, the next sort of capital you might want to deploy. So revenue, number one. Number two, you could have like grants, or you can have your own time, which comes with a certain element of risk. But the promises you're making to the other side of the ledger need to be upheld. Right? So a grant, you're gonna have to do a whole bunch of reporting. Um, when you borrow, when you get to the point where you're able to borrow, and to be clear, you can't borrow until you've got revenue. So you're not for that sort of, I've got an idea on the back of a napkin. You're already at the point where you're doing 50, 60, 100, millions of dollars in revenue a month, and you need to use that as effectively the engine to get more. Is that, when you borrow money from me, you promise to pay me back that capital over a period of time plus some interest. But it's a known. And the interest rate might be 20%, just for argument's sake, but it's not 400% per year, which is what you're talking about when you're selling shares.
Yeah, that's what you're talking about. Yeah, that's fair.
So
Yeah.
it's an interesting conundrum around, what's cheap and what's expensive. It depends, right? It's
Mm.
so, the reason you might want to sell those shares and hand over that equity is because, you need that capital to build the product, or better still, you need that capital to chase that massive market, and you feel like there's an opportunity that has a bit of speed attached to it. We need to go fast. That said, VCs will tell you that every time. The winner takes all. You got to go to market. Blah, blah, blah. I can guarantee you that, number three through 20 in most categories are still a multi-million or $100 million business
And
quite
there's
often,
nothing wrong with that at all. Yes,
right? And they
seriously.
went, they
Yeah,
just took a different path, and there's
yeah.
nothing wrong with that.
Mm.
Um, but so the conflict of the people who are telling you're awesome and want to buy shares off you, and this is what I say, especially when they're at that point where they are scaling, is like, if somebody wants to give you money for your shares and you've got a bunch of revenue that's growing, that's the right time to consider whether or not you start to blend your capital stack with maybe some equity, maybe some debt, or both, or one or the other, right? So using, as we mentioned before, once you're in that sort of growth engine where you can effectively buy, for lack of a better term, revenue, especially if it's long-term revenue, you know that your LTV or your customers stick around for years because the product's good, and you can invest the first 6 months of their thing, or first 12 months even, to buy 3 months worth of 3 years worth of revenue. Like, that machine is completely fundable with non-equity money if you get that level of understanding.
Got
Um,
it.
so, and that's just something that most people don't think about. Go back to the problem. Most founders care about their problem, and they care about their customers, and they care about their team, and they care about their product. And caring about when you start to sort of the cost of your internal capital, which is the amount you've promised for your equity, and then starting to promise some lenders and whatever, is something that most founders do leave right till later. And nowadays, with people like ourselves, you can have that conversation sooner rather than later, or at least understand how they all interplay with each other.
Yeah, what the options are, because it's like you said, it's maybe not this or that. It's maybe this and that, and how do you blend it, and how does it work? And maybe it's angel plus debt. Maybe it's different angles, if depending on size and scale opportunity. So there's different ways to think about it, not just let's go after a VC and do that option. But you've got different opportunities for people to build a business.
The other thing that we often say to founders is, like, equity is rarely fast. Like, it takes a long time. It's a funnel. It's a sales process. You speak to a lot of people.
You're just selling, yeah, shares. That's what you're, these, here's what you are, you're selling shares and you're out there, you're promoting. That's what you're doing. Yes.
If you don't allow, like, that time comes at a cost as well, especially if you're growing and you're doing founder-led sales. Now you're doing founder-led sales to the investors, and you've taken your foot off the accelerator on the customers. Your revenue might slow down a little bit. 6 months later, your investors are like, "Oh, why is your revenue slowed down?" And you're trying to sell shares. You're like, "Because I'm trying to sell shares instead of selling product." And the trade off is real. Like that I see that often where it's like, "Oh, we're just going to go raise some equity." Oh, like we approve a loan. We approve a loan. Here's $1 million. Pay us back over 2 or 3 years. You've got a decent business. Oh, we're going to go do some equity instead. I'm like, okay, that's probably going to take a long time. It's actually going to be more expensive for you in the long run, for you as a founder, from a dilutive perspective, potentially. And we can get this thing done next week. If you've got a job, we think you've got a great business. We want to help you grow it. You can keep the growth engine running. You know, Off you go. So I think that
It's definitely a different way to consider it for the founder.
the
It's,
time-based risk of
mm.
focusing on raising versus focusing on growing your business is misunderstood and not thought about very often.
I don't think people understand how long it takes to raise. Sometimes it can take 12 months. It's
Yeah,
quite easy.
yeah.
Yeah,
Over the
yeah,
last 2 years, it's taken
yeah.
people like never, like because they never
Yeah,
got there.
never. Yeah, exactly. That's fair. Especially out of Oz, it's a little bit more difficult again. You're in a country that's a bit more difficult to raise capital. That's the reality where we sit in Australia. We're not in the US where it might be a little bit easier. But even markets are different at the moment, right? So, like you said, the whole market's been different. I think they've freed up a little bit at the moment, but for how long? What are you seeing in the space of investment? You're around it from all angles.
Yeah, I mean, so a couple of things. Like it's highly correlated to um, the interest rates because ultimately people are looking for a return. And when the interest rates are really low, you can't get that return from the less risky things, right? Because that's the whole point. The RBA, drops their stuff down to zero or it's really low, which means if you need a return, you need to chase a bit more risk. So as the interest rates come up and people can leave their money in the bank and get 5% on a term deposit or whatever, they're like, the delta between that and maybe the 15% they might want or 20% they might want off a risky thing, like, that reward is not there anymore. Like, so I'm just going to leave it over here, which means there's less capital going into the alternate stuff, which means there's a smaller pie for the founders to pull from because the people they're getting their money from are also raising money all day long, and that's drying up a little bit. So we live in private credit land where I've got lots of money to deploy. We pay a good coupon, and the people that we get our money from are locked up for less than the money that the VCs want. We pay them interest every month because we borrow and then lend it, and we borrow big chunks and lend it in little chunks, and that's how we work. But I guess the point being there is that, yeah, that the the market dictates how much risk people, the market dictates the floor on where the risk setting is. So when the interest rates are really low, you've got to go deploy capital into slightly more risky things to get your average return. When it comes up, it recedes.
Yeah,
And
okay. So as interest rates are dropping, we see a little bit more capital flowing into this part of the ecosystem, I would imagine.
Yeah, and even
Yeah.
like for us,
Mm.
the interest rates do exactly what they're meant to do. As the bank puts them up, as the RBA
Mhm.
puts them up, it pulls the energy out of the entire
Mhm.
system, including the business economy, right? So
Yes.
we spoke about earlier about a founder, taking some money to grow their business. They need to have the confidence. They're going to borrow. They need to know it's going to work.
Yeah, you've still got to grow, yes, because then what happens here?
if
Mm.
they're if they're seeing their customers hesitate
Yes.
or churn or come
Mm.
back going, look, procurement
Hmm.
is making me negotiate for
Mm.
lower rates. If we're not, we may not be able to
Mm.
use that kind of thing. So all of a sudden, the enthusiasm is
Hmm.
inversely correlated to the interest rate. So as interest rates go up, enthusiasm goes down, and as interest rates come down again, enthusiasm starts to go up, and they're quite
Yeah, they
highly
work hand in
correlated.
hand. Yeah, they do go
Yeah.
hand in hand for sure.
So,
Yes.
so if you go back 20 years and look at the interest rates and then overlay borrowing, for instance,
Hmm.
they sort of, one goes down, the other one goes up. And equity has got its own pattern in relation to that kind of stuff for the reasons that we just spoke about.
Oh, perfect, mate. Matt, I'll end it there. Thanks for joining us on the DevReady Podcast. It's been a pleasure talking about all things investing, startups, angels, Tractor, just sharing about what's possible for people to look at from a different way of bringing funding into their startup or their venture or their business, depends on how you want to frame it. Thanks for joining us. And if anyone wants to find out about yourself or Tractor, how do they do that?
Factorventures.com is where it's all at. There's a calculator on there. Go and throw a few facts in about your business, and we'll tell you how much you can borrow. And I'm just on LinkedIn there all the time, Matt Allen.
Perfect, man. No, really been a pleasure.
Thanks for having me.
Cheers, mate. Thanks a lot.
Catch you later.